There's three key areas that we should focus on. Let's start with the U.S. economy. 2022 was a year that was plagued with high inflation, uncertainty at the beginning of the year if we were truly in a recession or not in a recession. Growth was relatively timid, but the labor market remained resilient. The fact that that was happening in many ways suggests that we don't have a recession and perhaps we can actually have a soft landing. But our view is that this is a year where we're going to likely pass the baton from inflation concerns to growth concerns, because many of the leading indicators that we track, like ISMs and PMIs, LEI indicators, are all suggesting, as well as the yield curve, are suggesting that perhaps we are at the precipice of a recession. Turning to the Fed, which was very aggressive last year with monetary policy, they're aiming to likely push rates into the 5% level or higher to try to continue to combat this elevated inflation. Meanwhile, they're also doing a process known as quantitative tightening, known as QT in the marketplace, where they're also draining liquidity from the system. Those two forces at play are trying to impact financial conditions and ultimately aggregate demand to slow down the economy and try to arrest inflation. Finally, turning to the markets, after years of low rates, we're seeing rates rise globally. First in the US, now in Europe, and even in Japan, which has had historically low rates, has seen a rise in rates. What's the significance of this? Well, perhaps we're going to see a changing in behavior from investors that will prefer to buy their local bonds at higher rates versus shifting capital to the US, which has been a recipient for foreign flow for many years. The US bond markets in general had a very difficult 2022, one of the worst performing years in history. That was also true for the credit markets, but they were largely impacted by the higher rates. If rates remain elevated, both in the US and globally, it's quite possible that the credit markets, even after a rough year, may have another rough year. So our view is that we think that the credit markets haven't properly discounted the lags effect of the higher rates and also the potential upcoming recession if we do indeed fall into one. Those forces, I think, are not priced in properly into the credit markets. Meanwhile, you have a government bond market that has a yield curve that's inverted. These things are inconsistent. A very kind of robust credit market and a bond market from the sovereign side saying that we're heading towards a recession. We think that ultimately the government bond market will be proven right. It might be too early. Meanwhile, credit is overvalued as it starts off the year.